Cell 1. In this cell, we're diving into the concept of transfer pricing, a critical area in finance and accounting that influences various aspects of multinational corporations. Understanding transfer pricing is essential because it directly impacts how profits are allocated among different parts of the company, particularly when those divisions are located in different countries. This arrangement can influence tax obligations, performance measures for various departments, and even cash repatriation strategies. At its core, transfer pricing involves establishing the prices charged for goods, services, or assets exchanged between divisions. This pricing mechanism is vital because it can dictate where profits appear on financial statements, which in turn affects tax liabilities. We have key elements in play here: the internal pricing decisions and regulatory requirements. For instance, tax authorities often mandate what's termed arm's length pricing, which means that the prices set between related entities should mimic those that would be agreed upon by unrelated parties under similar circumstances. Moreover, it's important to explore how these prices influence performance measurement within divisions. If one subsidiary appears to be generating higher profits simply due to favorable pricing strategies, it may misrepresent the actual performance of each division. Cash flow considerations also come into play. Companies need to be mindful of customs duties and regulations when pricing their internal transactions, as these can affect overall liquidity. One potential pitfall is the complexity surrounding regulatory compliance, as different countries may have diverse rules regarding transfer pricing. If a company inadvertently miscalculates or misrepresents its pricing, it risks attracting scrutiny from tax agencies, which could lead to fines or adjustments in tax obligations. As we transition to the next cell, we'll likely explore how companies can analyze their internal pricing strategies and understand their impact on overall financial performance. Exciting discussions about data-driven methodology to optimize transfer pricing will be on the horizon. Cell 2. In this cell, we're diving into the world of transfer pricing methods, which are essential for determining how transactions between related entities are priced. This is particularly important for multinational corporations, as it affects tax obligations and compliance with international regulations. We begin by exploring several key methods that practitioners commonly use. First up is the comparable uncontrolled price method, often referred to as the CUP. This technique leverages market prices from transactions between unrelated parties to set a fair price. It's a straightforward approach, but it relies heavily on the availability of comparable transactions, which can sometimes be challenging. Next, we look at the cost-plus method, which takes the incurred costs and adds a markup to ensure the transaction reflects an arm's length standard. This can be simpler to calculate, but it also risks inaccuracies if the cost structures differ significantly. Then there's the resale price method. Here, the focus shifts to the final sale price. After determining that price, we subtract a distributor margin to arrive at the transfer price. This method is particularly useful when the reseller's role is significant, but it assumes that the sale price is well documented and consistent across markets. We also highlight the transactional net margin method, or TNMM. This approach ensures that the margins achieved by the tested party fall within an acceptable range compared to similar entities or transactions. It's rather analytical, as it requires a thorough understanding of net margins in comparable scenarios. Lastly, we discuss the profit split method, which divides total profits among entities based on their respective contributions, like intellectual property, risk, and functions performed. This method facilitates a fair distribution, but can become complicated when determining the value of each contribution. As we progress to the next cell, we'll likely delve into practical applications of these methods, bringing in real-world examples and perhaps some calculations to illustrate how these concepts work in practice. This will provide us with the tools needed to apply these theoretical frameworks effectively. Cell 3. In this cell, we're focused on calculating the financial metrics for two subsidiaries of a company, one located in Mexico and the other in the United States. This process is essential for understanding how internal transactions affect the overall profit and structure of the business. To start with, we establish some key parameters, including the number of units manufactured and sold, the cost structure for production in Mexico, and the selling price in the US. This setup includes crucial details like manufacturing costs, distribution expenses, and applicable tax rates. The objective is to calculate the transfer price, which determines how much one subsidiary charges another for goods exchanged between them. In this case, it's a cost-plus model, where a markup is added to the manufacturing costs to arrive at the transfer price. Once we have the transfer price, we move on to compute both subsidiaries' profit and loss statements. For the Mexico subsidiary, we calculate revenues based on the transfer price and determine the earnings before interest and taxes by subtracting costs of goods sold. Meanwhile, the U.S. subsidiary's income is calculated from external sales, accounting for its own costs and operating expenses. Next, we consolidate these figures to get a holistic view of the company's earnings before interest and taxes, keeping in mind that internal sales don't impact consolidated revenue. Afterward, we apply the relevant tax rates to derive net profits for each subsidiary and calculate the total after-tax profit of the organization. An important check is conducted to validate that the U.S. subsidiary's operating margin falls within an arm's length range, ensuring that internal pricing practices are in compliance with fair market standards. Finally, we summarize all these metrics in a clear table format, which presents the key figures in a more digestible layout. This enhances readability, making it easier for stakeholders to grasp the financial health of the subsidiaries. Looking ahead, the next cell will likely involve a deeper examination of these results, possibly exploring how different scenarios or adjustments might impact the overall financial outcome. Cell 4. In this cell, we are examining the transfer pricing mechanics between two subsidiaries of a company, specifically focusing on how these internal transactions shape overall profitability. Understanding this process is crucial, as it highlights how pricing strategies impact financial statements while remaining within compliance. We begin by looking at the transfer price per unit, which is set at $26.55. This price is crucial because it represents the cost at which the Mexico-based manufacturer, referred to as Sub A, sells products to the U.S. distributor, Sub B. The manufacturing cost stands at $22.50, and after applying an 18% markup, we arrive at this transfer price. It's essential to notice how this pricing strategy affects both subsidiaries' financials. Next, we dive into Sub A's earnings before interest and taxes, or EBIT, which totals $405,000. This figure comes from the difference between revenue generated from internal sales and the cost of goods sold, calculated by multiplying the profit per unit, $4.05, by the total units sold. This calculation reflects how efficiently Sub A is operating, as it shows their operating profit from internal sales. Turning our attention to Sub B, we find that its EBIT amounts to $825,000. The U.S. distributor calculates its profit by considering external sales revenue and subtracting both the internal purchase cost and operating expenses. Here, Sub B earns $8.25 per unit after these deductions. This demonstrates how transfer pricing impacts the distributor's profitability, influencing pricing strategies when selling to end customers. When we consider both subsidiaries together, the consolidated EBIT reaches a substantial sum of $1,230,000. This figure is derived by assessing the combined revenues and costs across both entities. Interestingly, the key takeaway here is that transfer pricing mechanisms do not alter the total economic profit of the entire company. Instead, they affect the distribution of profits across different parts of the organization. As we move to the next cell, we will likely explore implications of these calculations, perhaps delving deeper into regulatory considerations or how businesses can optimize transfer pricing strategies to ensure compliance while maximizing profits. Cell 5. In this cell, we analyze the concept of the arm's length check and its implications in transfer pricing compliance, particularly highlighting why a specific margin does not meet regulatory expectations. This is crucial because ensuring that intercompany transactions are priced fairly can help companies avoid penalties and maintain good standing with tax authorities. The cell establishes that the acceptable margin range for an arm's length distributor is between 2% and 6%. However, we encounter a significant deviation with Sub B, which reports a margin of 21.15%. This stark contrast is not just a minor discrepancy. It triggers a fail verdict in our check, indicating that the current pricing structure raises red flags. What's really at stake here is that if a tax authority were to scrutinize this arrangement, they would most likely conclude that the U.S. distributor is generating excessive profits compared to what an independent distributor would earn under similar circumstances. This excessive profit margin can be seen as an indicator of non-compliance, potentially leading to costly audits and adjustments. As we move forward, it's essential to understand that compliance risks like these can have real financial implications. The lack of alignment with established margins can prompt regulatory reviews, resulting in severe penalties if deemed inappropriate. Therefore, organizations must rigorously assess their pricing strategies to align properly with the arm's length principle. In the next cell, we will delve deeper into the strategies companies can employ to rectify such discrepancies and ensure a more compliant transfer pricing framework. This will not only mitigate risks, but also create a more sustainable and defensible pricing methodology. Cell 6. In this cell, we're examining the strategy of adjusting the internal transfer price between two subsidiaries, specifically to align profit margins with external benchmarks. This step is crucial because it directly influences how profits are distributed between Sub A in Mexico and Sub B in the United States, which can have significant tax and financial implications. The heart of the logic here lies in the concept of transfer pricing. By increasing the transfer price, the internal price at which Sub A sells goods or services to Sub B, we effectively reduce Sub B's profit margin. This not only shifts more profit towards Sub A, but also ensures that Sub B's operating margin moves closer to the desired range of 2 to 6%. This transition is important, since Sub B, as it stands, is currently reporting a large operating margin of 21%, which deviates significantly from the expected benchmarks. As we explore this further, we see the underlying assumption that the cost-plus transfer price, initially set at $26.55, is mechanically sound. However, it inadvertently results in a mismatch when compared to what we anticipate a typical distributor's operating margin should be. If we maintain the current pricing structure, we might run into compliance issues, as it doesn't reflect an arm's-length agreement that should ideally mirror market conditions. This consideration prompts us to think critically about our overall financial strategy. It may necessitate either an increase in the transfer price or a reevaluation of the functional profiles and benchmarks we're using to guide these decisions. Moving forward, our next step will likely involve implementing these adjustments and assessing their impact on both subsidiaries. This allows us to refine our understanding of transfer pricing in practice and ensure that both subsidiaries operate within a framework that reflects the economic realities of their market positions. Cell 7. In this cell, we're diving into the financial mechanics of setting a transfer price for a distributor, ensuring it aligns with our desired margin. This analysis is essential for understanding profitability across different subsidiaries and ensuring operational efficiency in our pricing strategy. We start by calculating the target transfer price based on our objective of achieving a 4% margin for the distributor. This involves multiplying the selling price by the margin threshold and adjusting for operating costs, which results in a foundational price that we can utilize for further calculations. After establishing this transfer price, we move on to reevaluate the profit and loss statements for both subsidiaries involved. For the subsidiary in Mexico, we compute the revenue generated by multiplying the target transfer price with the number of units. We then assess the cost of goods sold by multiplying the manufacturing cost per unit with the same quantity. The crucial step here is to derive the earnings before interest and taxes, or EBIT, which gives us a glimpse into the financial health of the Mexican operation. Next, we pivot to the U.S. subsidiary. Here, the revenue is calculated using the final selling price, while the cost of goods sold reflects the target transfer price. Additionally, we account for the distribution operating expenses to get an accurate EBIT figure. It's important to note that this structure helps in maintaining consistency and reinforces our consolidated EBIT, which should remain unchanged because it is based on overall business performance rather than intercompany transactions. As we consider tax implications, we assume a simplistic positive income scenario, calculating taxes for both subsidiaries dependent on their EBIT results. We then derive the net profits by subtracting the calculated taxes from each subsidiary's EBIT, achieving a comprehensive view of the global after-tax profit. We summarize our findings in a structured table, providing clarity on key metrics such as the transfer price, EBIT figures, and effective tax amounts. We also examine the operating margin for the U.S. subsidiary, presenting these insights in a visually digestible format. In our next cell, we will likely explore how these figures influence strategic decision-making, perhaps looking at break-even analyses or optimizing the supply chain based on these foundational financial insights. Cell 8. In this cell, we're examining the implications of adjusting the transfer price related to the margin of a subsidiary. This adjustment is significant because it directly influences how profits are allocated between different regions, ultimately impacting overall tax liabilities and after-tax earnings. The key idea here is that by forcing the margin of the subsidiary in Mexico down to 4%, we are effectively raising the transfer price charged to the distributor in the U.S. This shift isn't trivial. It reallocates profit margins, which means that while the consolidated earnings before interest and taxes, or EBIT, remains unchanged, The distribution of profits can significantly alter due to varying tax rates in each country. This is a crucial point because different jurisdictions often have different tax implications, and moving profits around can either minimize or increase the overall tax burden. It may not be immediately apparent, but the method used to set transfer prices can lead to substantial financial reconfigurations across borders. Another consideration here is the potential pitfalls involved. For example, if the pricing strategy isn't compliant with the regulations governing transfer pricing, it might draw scrutiny from tax authorities. Awareness of these regulations is essential to avoid costly repercussions. As we look ahead, the next cell will likely delve deeper into specific numerical outcomes and projections from this transfer pricing strategy, helping us quantify its impact on the financial statements of both the U.S. distributor and the Mexican manufacturer. This will give us a clearer picture of how these strategic decisions ripple through the organization. Cell 9. In this cell, we're analyzing the impact of modifying the transfer pricing for Sub B, particularly focusing on how setting their margin to 4% affects the company's financial dynamics. Understanding this change is critical because it gives us insight into how internal pricing strategies can influence both entity-level profitability and tax liabilities across different jurisdictions. To begin, we specified that the transfer price charged by Sub B to the U.S. distributor has risen to $33.24 per unit. This adjustment is crucial because it ensures that Sub B's earnings before interest and taxes, or EBIT, aligns with the desired 4% margin relative to sales of $39 per unit. Therefore, the target EBIT per unit is $1.56, which we calculated based on that 4% margin. By rearranging the profit equation for Sub B, we synthesized the transfer price through specific deductions, confirming our calculations and demonstrating the inherent logic of allocation. Moving on to entity profits, Sub B's EBIT now stands at $156,000, precisely reflecting the established per-unit earnings multiplied by the total units sold. This effectively positions Sub B as a standard distributor, generating a modest profit margin that's consistent with our initial intentions. Meanwhile, Sub A reports an EBIT of $1,074,000, with per-unit profits calculated based on the new transfer price. This shows a significant shift of profits upstream, favoring the manufacturer over the distributor. Interestingly, while profit allocation between the entities has changed, the overall consolidated profit remains consistent at $1,230,000. This stability in consolidated EBIT highlights that transfer pricing alters profit distribution without affecting total earnings before tax, as the broader economic context stays the same. However, this strategic shift has implications for tax obligations. Sub A and Sub B incur taxes calculated on their respective profits, leading to a total tax liability of $359,640, which reduces the global after-tax profit to $870,360. The crux of the matter is that by moving profit into Mexico, a country with a higher tax rate of 30%, we inadvertently raised overall taxation, leading to a decrease in after-tax income compared to previous scenarios where profits were mostly sheltered in lower tax environments. As we proceed, we'll be introducing additional constraints to explore how these adjustments continue to influence our outcomes and refine our understanding of transfer pricing strategies. This will help us uncover the nuances of global operations in different tax landscapes, enhancing our comprehensive view. Cell 10. In this cell, we're calculating the feasible pricing bounds associated with two different market scenarios, Sub A and Sub B, and determining if there's any overlap between their respective ranges. This is an essential step in pricing strategy, as it helps ensure that we can meet the demands of both market segments without running into conflicts. The key variables here include the price of the product, denoted as P, which is set at $39, and the cost, C, which is $22.50. We also introduced two distinct margins for Sub B, ranging from 2 to 6%, and a markup range for Sub A, set from 5 to 20%. The computations begin by calculating the implied target pricing bounds for each segment. For Sub B, we derive the lower and upper limits by adjusting the base price with its associated margin and subtracting the cost. This gives us a sense of the price floor and ceiling we can work with for Sub B. Next, for Sub A, we factor in its markup on the base cost to find its respective target pricing limits. After gathering both ranges, the next step is to identify the maximum lower bound and the minimum upper bound across the two segments. This intersection will help us understand if there's a feasible pricing strategy that can satisfy both Sub A and Sub B. The printed results provide a clear view of these ranges. If the overlap exists, we're in a feasible situation. If not, We then delve into required adjustments for sub A's markup to align with sub B's more generous margins. By recognizing these possible adjustments, we can fine-tune our pricing strategy to cater to both segments effectively. Now, as we transition to the next cell, we will build on this analysis to refine our understanding of pricing adjustments in relation to market dynamics. Cell 11. In this cell, we're venturing into the realm of transfer pricing, a crucial concept in taxation and economic strategy. Here, we're using code to calculate key financial metrics related to two subsidiaries in a business context. Understanding these metrics helps companies assess their internal pricing strategies and potential profitability while staying compliant with tax regulations. We start with some foundational inputs, such as quantities sold, purchase prices, costs, and applicable tax rates for both Mexico and the US. These inputs set the stage for our analyses and influence everything that follows. The function defined next, metrics for TP, is integral to our process. It computes various metrics depending on the transfer price, which represents the price at which goods or services are sold between affiliated businesses. Within this function, we calculate earnings before interest and taxes, or EBIT, for both subsidiaries, reflecting their profitability before tax obligations are deducted. We also compute tax liabilities, handling cases where EBIT may be negative by ensuring that taxes can't be negative. This careful management provides a more realistic picture of financial performance. After calculating the respective net income for each subsidiary after tax deductions, we find the global net income, giving us a comprehensive view of overall profitability. Moreover, as you dive deeper, the function calculates margins and markups, which are essential metrics for assessing pricing strategies. These allow us to evaluate how much each subsidiary retains from sales relative to costs and can guide strategic decision-making. We build a grid of potential transfer prices using a wide range to explore how different prices affect profitability. This comprehensive range enables us to identify conflicts in pricing strategies between the two subsidiaries. Additionally, we compute feasible transfer price intervals implied by various financial constraints, emphasizing the balance companies must navigate between tax implications and operational efficiency. Lastly, a target transfer price is established, aimed at achieving a specific margin of 4%. This number could serve as a target for a more detailed analysis moving forward. As we look toward the next cell, we can anticipate utilizing the data visualizations to help illustrate these relationships and maybe even reveal some profound insights into the trade-offs present in our transfer pricing strategy. Cell 12. In this segment of our analysis, we're exploring the constraints on transfer pricing ranges by visualizing how different margin and markup requirements interact. This step is crucial because understanding the feasible transfer price options helps ensure compliance and optimization between distributors and manufacturers. We've created a figure that highlights the allowed ranges for transfer pricing based on two parameters. The first trace represents the margin range for sub B, showing a band that spans from a lower to an upper threshold, specifically between 2%, from 2% to 6%. The second trace outlines the markup range for sub A, which is a wider band, conveniently set to stretch from 5% to 20%. Utilizing this graphical approach allows us to visualize where the constraints of each segment overlap or diverge. An important feature of this output is the addition of an intersection marker that indicates the feasible range when both constraints are respected. If the low end of the intersection is less than or equal to the high end, we represent this with another line to illustrate this viable range quite clearly. However, if there's no intersection, we use a marker to indicate that the constraints conflict, which is a vital insight for decision-making. We then incorporate a target transfer price, specifically set to 33.24, which is marked as a dashed line within the graph. This serves as a benchmark, allowing us to compare our target against the established allowable ranges. The overall layout enhances clarity through effective labels and a comprehensive title, setting the stage for our analysis of how distributor margins interact with manufacturer markups. As we move on to the next cell, we'll likely delve deeper into the implications of these constraints, perhaps discussing strategies to adjust the target transfer price or how different scenarios could impact overall profitability. Cell 13. In this cell, we're creating a dynamic chart to illustrate how variations in transfer pricing influence the profit margins of two subsidiary entities, Sub A and Sub B. This visualization is crucial because it helps stakeholders understand the financial impact of pricing decisions on each subsidiary's profitability. The chart utilizes scatter plots to represent the EBIT margin for Sub B and the markup for sub A. Specifically, we're plotting the transfer price along the x-axis, while each subsidiary's associated financial metrics are presented on separate y-axes. This dual-axis approach allows us to easily compare the two sets of data, despite their different ranges and units. We begin by adding traces for the EBIT margin of sub B and the markup of sub A, both scaled to percentage values for clarity. This scaling ensures that comparisons are intuitive, allowing viewers to quickly grasp how each subsidiary's financial health is affected by changes in the transfer price. Additionally, to provide context, we've included horizontal bands representing the arm's length ranges for each subsidiary's metrics. These bands are critical for visualizing whether the current margins fall within acceptable limits. It's interesting to note that deviations from these targets could signal potential compliance issues or misaligned strategies. A vertical dashed line marks our chosen transfer price, giving a clear reference point on its impact relative to the plotted data. This will allow us to see expected outcomes based on our transfer pricing strategy. As we finalize the layout, we ensure that both axes are clearly labeled and visually distinct, making it easier for anyone reviewing the chart to interpret the information being presented. Looking ahead, the next cell will likely delve deeper into what these plotted results mean for financial decision-making, potentially offering strategies for optimizing the transfer prices based on insights gathered here. This will build on our understanding of not only pricing implications, but also strategic financial planning within the organization. Cell 14. In this cell, we're generating a waterfall chart to visually represent the profit distribution among different subsidiaries based on transfer pricing. This is particularly important in financial analysis, as it helps stakeholders understand how individual contributions impact the overall consolidated earnings before interest and taxes, or EBIT. To start with, we define our target transfer pricing and then compute the relevant metrics for that price. Key variables here are the EBIT values for each subsidiary, which are derived from the metrics we've calculated earlier. We then input those values into the waterfall chart. This visualization covers two subsidiaries, referred to as sub A and sub B, culminating in the consolidated EBIT figure. The waterfall chart is structured such that it displays the EBIT figures sequentially, illustrating how each subsidiary contributes to the overall profit. The chart differentiates between relative values, which show individual contributions, and the total value at the end, representing the consolidated output. A noteworthy aspect is how we formatted the text labels to present these figures in a clear, readable manner, enhancing interpretability. As we move forward, it's crucial to pay attention to how the assumptions we made regarding the transfer pricing could influence our results. If the underlying data changes, or if there are shifts in market conditions, our metrics, and thus our visualization, will need updates. Next, we'll likely explore how different scenarios can affect EBIT figures, and how they can be further analyzed. This upcoming analysis will deepen our understanding of financial performance and guide strategic decisions. Cell 15. This cell marks the conclusion of our current analysis. It's crucial because it encapsulates everything we've worked on, emphasizing the significance of our findings and how they fit into the larger context of our project. Now, stepping back, we can appreciate how every preceding cell has been guiding us towards this endpoint. Throughout our exploration, we've incrementally gathered insights, applied various methods, and examined our data closely. The final output serves as a comprehensive representation of our efforts, showcasing the results of our computations and analyses. What we've seen so far is not just a collection of numbers or statistics, but a narrative built from our data. It's important to reflect on the decisions we made along the way, how we processed information, which variables we prioritized, and the assumptions that underpinned our findings. One of the key takeaways is that each step was intentional, allowing us to build a robust understanding of our subject matter. Looking ahead, this completion doesn't signify an end, but rather an opportunity for evolution. The insights gained here can propel us into more advanced analyses or broader applications. Whether we're considering further experiments or developing new questions, the groundwork we've laid in this project will be invaluable. In the next cell, we will likely expand on these findings or explore a related area, adding even more depth to our understanding. So let's prepare to carry this momentum forward into our next adventure in data analysis.